Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this week's Monday Minute Live Chat hosted by the Canadian Leadership Congress. And today we're talking about navigating emerging markets in a low-yield world. And to talk to us about this, I have Regina Chi, Vice President and Portfolio Manager with AGF Investments, and Christian Hensley, Senior Managing Director, Equities and Credit at IMCO. Welcome to both of you.
Thank you.
Excellent.
Thanks so much.
Yeah, now look, my first question is about the pandemic. Emerging markets have certainly weathered it in myriad ways, depending on what geography you're looking at. Going forward, do you think it's going to have a lasting impact on these economies or not? And why do you think that is?
Maybe I can start. The COVID battle in emerging market is still very much with us. Many developing countries continue to face COVID-19 challenges. And so just when the cases start to moderate, there are flare-ups. And what we're seeing is in China, where we've seen a number of new cases coming up. And that started from the middle of October and is spreading to 19 provinces. And so they have a zero tolerance policy. As a result, there are just a steeper slowdown in the economy. And then you have other countries that seemingly did a good job, but you're seeing record daily infections like Singapore. Malaysia and Vietnam are doing somewhat better since they've lifted the restrictions in October. But the reality is that we haven't really seen a global synchronized recovery in DM and EM at all. And what's become more critical is that what we found that the weakest link during the 2-year period is that there's been significant supply chain disruption. And it doesn't look like it's going to be resolved until sometime next year. And I think that this is where we're going to have lasting impact. As you know, the supply chain disruption was driven by strong demand from the fiscal stimulus that we saw in the United States and globally. Lack of capacity. We've also saw labor shortages as well as complete breakdown of the supply chain. And it all began with the chip shortages. And this happened in 2019, starting with the US-China trade war. We saw clear inventory hoarding by manufacturers because no one really wanted to be caught on the wrong side of geopolitics. And then we had very strong and warped demand growth from the stimulus that I just talked about. And don't forget, we also had the weather disruption. We had weather disruption in Texas and then a fire in Japan. And so that really impacted the supply chain, which is not only hurting the auto sector, but also smartphones, computers, and other areas. And the key issue is that just when the chip shortages look like they're starting to ease, we learn how Malaysia plays a critical role in the supply chain. And what we found that is that Malaysia accounts for 20 to 30% of auto chip packaging. And so just when that country went into lockdown sometime in August, September, we realized that the disruption is just going to be further prolonged. So I think for us going forward, the key trends to watch will be the realignment of manufacturing closer to home, automation, redesigning of the supply chain, and I think we'll see more verticalization and regionalization as a result.
That's great context. Thanks, Regina. I want to pick up on a couple of things you've said. I mean, you've talked about a real dispersion of countries and markets. And Christian, I'd like your perspective on whether or not you think some of these geographies that are performing better than others. What does the dispersion of GDP growth look like across emerging markets? Because they're not a monolith. And how do you account for that, say, in your EM allocations?
Yeah, great question, and thanks. I think you used the magic word, the word of the day, dispersion. I think over time we look at emerging markets really as an alpha opportunity. It is a nice diversifier in many respects, but over time the differentiation between winners and losers in those markets is really more pronounced than in developed markets we find. So having active managers that can unlock those differences and play more aggressively to capture that value really tend to pay off. So first and foremost, categorically, EM is a great opportunity for that dispersion at the company level, industry level, and as you touched on, at the country level. I think one of the big themes that I've been keeping an eye on is really the growth rate story. Often EM is a bit of a levered growth story relative to the rest of the world. But what's driving an idiosyncratic outcome in these current difficult times, particularly with COVID, is the factors including stimulation. So the willingness at the fiscal and monetary level of the different countries to engage and drive performance, and vaccination levels. And so as we've witnessed those different pacing models unfold in different countries, those countries' ability to remain open, to be stimulated economically by those factors, fiscal and monetary, that's really driving a disproportionate performance outcome for us. And I would say overall, I mean, categorically as well, it looks like the developed world is above trend line pre-COVID, thanks to huge amounts of atom bombs of cash basically directed at those markets. However, some of the emerging markets countries have financing limitations, or they have other inflation concerns that could drive their willingness to actually get those stimulation elements in place. So we're trying to really deconstruct those different macro elements country by country and think about where those differences might lie. But the other broad overlay theme, and this is probably driving even more of our allocation, is the divergence in the emerging markets between almost regular way growth economies, typically in North Asia, and the commodity-driven economies of the world. We're now heading into more of a value cycle in some respects. It feels like you've seen energy prices spiking, driving value or harm, depending on the market that you're looking at. Europe paying a lot more in terms of energy, but Russia benefiting and so on. So looking at the economic impact of commodities applied to different countries is driving a bit of our allocation decision-making as well. So overall, I think it's that growth rate story. It's the ability to remain open thanks to vaccination levels and how that may differ country to country. And in summary, those countries that have more exposure to commodity growth at this narrow part of the cycle are getting a bit more attention of ours at this part.
That's
Caroline,
great.
maybe
Oh,
I
yeah,
can add to this because we've done a deep dive on in terms of what drives EM returns, and we totally agree with you that the view that EM is a homogeneous single asset class is completely misguided, because there are clear idiosyncratic characteristics for each country. That includes demographics, economics, and governance, and so we believe that EM countries should be viewed on an individual basis, and this other misunderstanding is that a country's GDP growth is an important indicator of a country's stock market. Right. And when we did a deep dive on this, we actually found that GDP growth actually explains only a small portion of the actual performance. The R square is only 0.13, is minuscule. And one potential reason for this is that sometimes local stock markets may not be representative of the local economy. So if you take Korea, for example, the large companies in Korea are multinational firms like Samsung, Hyundai, Kia, LG Electronics. All of these global firms with a lot of significant export sales and foreign operations. And so that doesn't necessarily translate that growth means that Korea as an economy is doing well. So, and then there are other countries like Indonesia and Thailand, where they generate the majority of their revenues domestically. So it's really a country by country, case by case. And one good extreme example is Brazil in 2016. The stock market was up 66% in US dollar terms that year. And this is when GDP growth was negative 3.3%. They were in a deep recession. But instead of looking at GDP growth, we like to look at currencies as one factor. They explain a significant part of the emerging market country stock market performance. And by looking at things like current account to GDP, real rate exchange, terms of trade will benefit quite a bit. And in fact, we found that country allocation in emerging market could explain as much as 23% of total returns over the last 10 years.
Yeah, and I like that. I like that sort of focus on GDP growth, et cetera, and which countries are outperforming. I mean, a broader question really is that emerging markets have been the engine of global economic growth but as these countries mature, we're looking at slowing growth. And what do you think that means for investors? And Christian, I'd like your take on that first.
Yeah, I think it's a great question and an interesting dilemma. I think when the tide's coming in for everybody, it's great for everyone to make money. I think when things become a bit more challenged, you're looking at China's growth rate slowing a bit. That's where I think differentiation and economies of scale, barrier to entry, really starts to matter for those companies. Management talent starts to really make a bigger impact. Innovation and so on. I think that's where you really get into that security selection skill set that's super critical in those markets, because it's not a beta play anymore of everybody on the rise or on the decline. And that's where I think that management skill and depth is something we focus quite a bit on, matters most. And as you look at even ESG factors, and given the long horizon that we have as investors, that sort of thing becomes quite central. So who's in the boardroom? How do they make decisions? How's the company positioned for the long haul, as opposed to very quick trading in and out sort of momentum plays? So anyway, I think that gets back to the core question there, which is what happens when growth starts declining? The answer is you got to execute better, and backing teams and companies that can is critical to success.
Yeah. Regina, is it time for a value rally?
Well, we don't pick a style per se, whether it's growth or value. We like to buy high quality stocks that are valued very attractively. That is the core of what we do. And so whether it's cheap or growth, it really depends on whether the companies have a very high cash flow return on investment. They have fundamental catalysts that's going to drive the re-rating. Yeah, we're indifferent about style. We're style neutral. We're a core product. We want to do both, and we want to do well in both regimes.
Yeah. One of the questions is access, right? Like, there's a lot of ways to access emerging markets and also China's market. What's the best way for asset owners to access some of these opportunities? Christian, what are you working on?
Well, we got a couple of different thoughts as well. And I think Regina mentioned something really important a few minutes ago, actually many things, but one of the things that struck me was the focus on capturing the real economy of a country, and if that matters, and it does. So if we look at China as an example, making sure you've got a proper blend of onshore and offshore exposures, I think is really important. That's representative of what China really is. It's a country with great potential. It's on the move. And it also helps you avoid lack of diversification by targeting very narrow niches or different segments that could be victimized by more international fund flows or technicals more than fundamentals. I'm more comfortable in a fundamental and kind of long-term framework there. So for us, it's important to get a blend of China A and China H and kind of construct our own benchmark as we're getting into the emerging markets and approaching them overall. And not to branch too far afield, but we're also looking at other areas like credit, where if you look at real rates and the potential returns you can generate there and the diversifying components that you can benefit from in the emerging markets on the credit side, those are all, I think, quite compelling for us. There aren't too many places in the world where you can get a positive return from a risk-free or close to risk-free sort of investment on the credit side. And we're taking a really hard look on the credit equation when it comes to emerging markets.
Regina, how are you viewing access right now?
I agree with Christian in terms of the offshore versus onshore, particularly in China. The A-share market is very inefficient. It's dominated by retail investors. So if you're going in as an institutional long-only investor, we're finding great opportunities there, and is a very good diversifier. So that is definitely one area that we have continued to look at. We're also we're going down the market cap spectrum, going to mid cap and small cap, and we're finding that a lot of these companies are not well researched. And so when you do good bottom-up analysis and talking to management and analysts on the ground, we're finding opportunities there too.
That's great. Regina, just to dig into that a little bit in terms of data and market inefficiencies and this broad spectrum of markets, how difficult is it to get the good data to make these decisions on, and how have you solved for that?
Yeah, so we by speaking to management is clearly one way, and having consistent conversations with management teams. We also do very deep dive modeling, modeling to understand our base case scenarios, bull case, as well as bear case. We normalize for accounting differences across the world. That allows us to look at companies on an apples for apples basis, and so that allows us to really look at real returns on real cash levels rather than accounting terms. I think our deep fundamental analysis allows us to get through some of these issues on a country basis. But separate from that, when we think about ESG, we integrate ESG in our analysis, whether it's explicit or implicit assumptions. But in terms of governance, when we think about governance from a high level, we put an ESG risk premium in our DCF to capture any risk that could actually impact stock returns. For example, a lot of our Chinese companies, we've applied an ESG risk premium to capture the national duty that some of these companies have to serve as a result of some of the top-down initiatives by the Chinese government.
Yeah, and ESG is a really big topic right now. And again, if we're not looking at emerging markets as a broad monolith, how do you approach ESG for this allocation, and how do you think of that across markets? Christian, let's get your thoughts to start.
Yeah, well, I think first and foremost, ESG is really critical for us. It's one of our highest priorities, and as we look at opportunities, screen them, and evaluate them, it is a critical component of our underwriting. And so, just to put it first and foremost, we're applying that ESG philosophy not just to the individual holdings, but also to our partners. And so, in part, we are relying on many of our external relationships to penetrate these markets to get the on-the-ground knowledge that we really could benefit from as well. And making sure they've got the right philosophy, the right approach. But I think taking a step back, to me, the principles of ESG are very much aligned with long-term investing, period. I'm not here to pitch ESG. I think we're all on board with it. But the idea of having a social license to have a governance model that makes sense, where there's accountability and control, businesses that you can be proud of, and that literally won't be underwater in 10 years by virtue of climate change or otherwise. If you do want to buy and hold and partner with companies to unlock value for very long periods of time, as we do, those principles are really central. So we use data as well. We have parties that provide screens and input there. We use qualitative and quantitative measures to evaluate partners and companies. So we do take a fundamental approach and understand businesses, models, supply chains, all the usual buzzwords, Porter's 5 forces. But we also have a factor team and a quant team and a macro team that effectively overlay their findings. And that's a great discipline tool for us as well. So we've got a fundamental team that has a couple of favorite names, but the factor team runs large scale screens and identifies signals that conflict with some of the ideas or thoughts that we're having on the fundamental side. It's an opportunity for partnership and for the best idea to win. And so we try to take a blended approach there to ultimately target just the right subset of companies we need.
Regina, from your standpoint, how are you applying some of these criteria? And do you think when in your conversations with asset owners, people have misconceptions about, say, the approach to climate change or some of these issues in emerging markets?
Yeah, there's wide dispersion of EM disclosure. And so that is a challenge for investors like us. China is very ambitious in terms of how they plan to decarbonize. India just made their announcement this week during COP26. And then you have other countries that are still trying to figure it out. And so within that means that there's also wide dispersion on the corporate level. And it's very wide between DM and EM companies. Some companies have CSR reports and some people have sustainability officers, and others have none. So for us, engagement is critical to have a better understanding of ESG risk and opportunities and how companies are trying to deal with them. And I think that, having a wide common approach is wrong for emerging market, because it's going to take time for certain countries to adapt. I mean, the good news is that they are adapting, and the problem is that it's going to be slow, because sometimes it's culturally related. So we think that by having the engagements and trying to have a better understanding of their perspective allows us to also have a better understanding of these issues on hand. For example, we just recently had a ESG engagement with a Brazilian dental company. The company doesn't have a third-party rating at all. They don't even have a CSR report. So what we need to do is look at all of our other engagements within the healthcare space and try to identify similar risk and opportunities for this company. So having this backlog of information helps us quite a bit. So we start with a third-party data agency like an MSCI ESG company, but that's only the starting point for us. This is because ESG data is backward-looking. Secondly, there's very little comparability between rating agencies. You can see that that MSCI ESG has different ratings than ISS. And then also, there are also inherent biases in the rating agencies, and there's especially for large companies, because they'll have the resources to do ESG analysis and having an outlining the sustainability risk. And then separate from the engagement and the fundamental analysis that we do, we'll also use proxy voting as a lever. We think that proxy voting is a good way to advance our ESG objectives. And we have voted against corporate directorship to move things along.
Yeah, and I think those are really important factors. Another big issue, I think, that is looming right now is the specter of inflation. We're all grappling with it, certainly here in Canada and North America. Does it impact your look for emerging markets? How should we be thinking about inflation as we move into 2022 with regard to emerging markets? And Christian, you're nodding there. Do you want to share your thoughts?
Maybe I shouldn't have nodded. That's a widowmaker question there. Those are hard, to pick spots, pick parts of the cycle to time these broader macro trends. But I think to some points earlier, I think as you've highlighted as well, choosing to view EM monolithically or that it's homogenized market, I think is always going to be dangerous. So we do try to think about those subsegments, those countries, those markets that do benefit from or are at risk of victimizing or being victimized by inflation. I think we are taking a close look at those commodity-driven emerging market countries at the moment, seeing how well positioned they are. We're trying to be very careful about our factor weighting overall, not necessarily going long value, but making sure we're neutral so we don't get caught out if the market dynamics do continue to shift and that performance trend continues. And on an active risk basis, we're looking for outliers there. Are we underweight Saudi Arabia at a time where, of course, they're on a tear for a number of obvious reasons? So we're trying to keep an eye on it in that way, but also remembering that a good part of this inflation effect we're seeing is really scarcity driven. It's really supply chain disruptions on the goods side that are driving these prices and the increases we're seeing in domestic markets like Canada. And so making sure that we have a handle on that supply chain as best we can. And also I'd say there's a view that isn't going to be a sustainable shortage, that over time these producers are going to build their capacity or they're going to recover in a way. And as these markets open, the demand side may shift more to services. So we also don't want to put all of our eggs in one basket, pile into some commodity trade when it's been the scarcity supply story, partly driving the inflation story, and then wake up a year from now when services are booming and the regular way economies are really soaring. So we're trying to keep an eye on all those dynamics, but having a balanced approach, I think, is going to remain critical here to make sure that you don't wind up in a tough spot.
Regina?
Yeah, I would love to add to this because I know there's great debate on whether inflation is transitory in developed countries like the United States. But for what I see in emerging market, there is no debate on inflation. The bottom line is that the inflation rates in various countries, whether it's Latin America or Eastern Europe, Russia, it's been ticking higher at a much faster rate. So as a result, interest rates have been going up. In certain developing countries like Brazil, Turkey, Russia, as I mentioned, we saw very aggressive tightening. And Eastern European central banks, more recently, whether it's Poland, the Czech Republic, are now following suit. So if you actually look at the total rate hikes in emerging markets by the central banks, they've increased by about over 1,500 basis points. That might be conservative as of 2 days ago. And despite this, real rates in these countries still remain in negative territory, anywhere between -1% to -4%. So that's a key concern for me that I'm watching, and it's not so clear whether it's transitory or not. And so, the next risk for us would be like, is this going to lead to stagflation, right? And you're going to have potentially a lower growth environment with persistent inflation. Having said this, despite the fact that both inflation and rates are on the rise in emerging markets, I don't believe that there are reasons to believe that there's going to be a taper tantrum that we had in 2013. And the key differences are that in that period, there were much larger external imbalances that were built up going into the taper tantrum, deeper current count deficits versus today. And a lot of those countries that got hurt in the taper tantrum, as Christian is talking about, are commodity producing countries that are benefiting from higher commodity prices. So that's the good news. And on top of the fact, they're raising rates, right? They're starting to raise rates before the tapering even was discussed, which was, for the Fed, they're saying that they're going to start tapering this month. Well, the EM central banks have been raising rates since the middle of this year.
Wow. Okay. Well, let's look into the future. Okay, and let's look at some broad themes you think are going to drive growth in emerging markets moving forward. And Christian, what are you looking at right now?
Well, I think the demographic story remains very interesting. I think that underlying GDP growth story remains very interesting. Making sure, and as Regina had mentioned, that does align to equity performance over time, but that is something that we're keeping a close eye on. But I think more importantly, as we think about attacking those markets, that market cap story, do you go mid cap, small cap versus large cap, is an important ingredient as well. So making sure we remain diversified at the country level, so we do capture that overall growth trajectory and the demographic yield that comes with. But also making sure that you're expressing that investment opportunity or that view through the real companies that are benefiting, the real companies that are performing through that cycle, and making sure that you're a bit insulated, or you're trying to keep an eye on those macro rotation or momentum plays, the capital flows that usually hit those offshore in China or those large cap names overall. I think if you want to talk, and I don't want to go out on too much of a limb here, but about long-term potential, I think you do want to have that fundamental underpinning, capture that dispersion of talents, use the right on-the-ground managers that can help you target the right companies that will outperform, and express that investment view through those typically smaller, mid-sized businesses that are real and sustainably contributing. Those are the overall, I would say, trends and strategies that we're thinking very much about.
Regina, what themes are you looking at right now and into the future?
Yeah, so there were 4 big themes that we were looking at pre-COVID, and these would be the same 4 post-COVID. And they would be deglobalization, digitalization, automation, as well as localization. And they're very much intertwined. And pre-COVID, they were driven by different things, and even post-COVID, they're driven by another set of factors, but they're very much tied to each other. So deglobalization is something that I've been talking about in terms of, that's going to be led by the supply chain disruption. Initially, we had thought that we were going to see deglobalization driven by technology, right? Just having more 3D printing that may mean that you're going to have more manufacturing closer to home. But the supply chain disruption means that you're going to see potential breakdowns of the current supply chain to make production much more cost efficient and to not rely on one single country like China or Vietnam. Digitalization is a theme that's been ongoing in emerging markets, and we've all seen how countries can move up the value chain very quickly as they digitalize their economy. This will continue, especially when you have e-currencies or the renminbi, which is going to happen in the beginning of next year. We also heard that Nigeria announced their e-currency, which will mean just greater financial inclusion. And the smartphone, as you know, is your digital wallet that you can have. You can have all your applications in one place. And so we're seeing a lot more innovation as a result as countries adopt digitalization. First, it started with China. And then we're seeing a lot of new unicorns popping up in India, Indonesia, Brazil. So that's a very positive trend. Automation is an area that we continue to like. We believe that there would be higher robotic density pre-COVID. That is actually now speeding up quite a bit as a result of the manufacturing disruptions that we saw and also labor shortages. And we think that that intensity will increase. And then finally, the new theme would be localization in China and self-sufficiency, which is in line with the government's aim. And so we're seeing companies that have the ability to overtake some global multinationals will continue to gain market share at the expense of some of these companies. And so companies like Estin Automation or even MindRay that will gain market share from Roche or Abbott or Fanuc and others.
Wow, I loved that look into the future. That's fascinating. Thank you for sharing those. And I want to thank both of you for your fantastic comments today. It's been a really robust and interesting discussion. So thank you very much for joining us, both of you, Regina and Christian.
Great, thank you.
Thank you so much for having us.
Oh, absolutely. And I want to thank everyone for viewing today, everyone who signed on to listen to our discussion. And this wraps this week's Monday Minute. Don't forget to send us your questions and we'll get right back to you with Regina's and Christian's response. They'll be timely, I'm sure. And thank you so much for joining us and see you next time.